Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. So what do we have in store for you on today's show? First up, we're going to be talking about the stock market and the presidential election. What impact has the election of Donald Trump had on the market, and was it what everybody anticipated? So I want to take some time to talk about that. Up in our second segment, we're going to be joined by our tax pro, none other than Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. We're going to be talking about year-end tax planning because, yes, it's that time of year where you got to think about those moves you can make before the clock strikes midnight on December 31st. So he's going to have some tips for us, and he's also going to talk to us a little bit about what he anticipates along with the Trump presidency. And we're also going to be talking about your retirement funds. And the question I have for you is, do you know where all of your retirement funds are? Now, you might think the answer is obvious, but for many people, they may have misplaced some of that money. We're going to talk about how prevalent that is and what you can do about it. And then finally, we have a viewer question on adjustable rate mortgages and rising interest rates. So we're going to be talking about that. So let's leap right into it. First thing I want to do is talk about the stock market. And I think that what's happened since about a week before the election, through the election, and today, and keep in mind this show is taped about 2 weeks before you're likely to be watching it, what has happened in the markets has caught everybody by surprise and is perhaps not exactly what most investors expected. But I want to talk to you about exactly what the numbers are, and I want to use it to illustrate the point that I've always made, which is you can't guess what is going to happen in the markets. And if you make any kind of radical moves to get in or out based on what you think is going to happen, you may be sorely disappointed. So without further ado, let me throw up this slide. And this is what's happened with the Dow since about a week before Election Day. So what we're looking at here in the start of the graph, October 31st is a Monday. Dow is poised to start going down. If you remember your recent current events, essentially James Comey, the head of the FBI, came out and talked about how they were reopening the investigation into Hillary Clinton's emails. And the market at this point had expected that Hillary Clinton was going to be elected, and although performance was choppy, it was pretty strong. Well, when Comey made that announcement, the market started to decline. In fact, by Friday, November 4th, the Dow had closed down at 17,888 after a week of declines. Now, over the weekend, Comey announces that they have not found anything new and they are closing the investigation once more. Well, the market expects now Hillary Clinton is in fact going to be elected. The Dow jumps to 18,259 on the strength of that announcement. Along comes Election Day. Not a lot happens. The market's still expecting Hillary Clinton to be elected President of the United States. But when the returns start coming in that night, it becomes pretty apparent early on, around 9, 10 o'clock at night, that Donald Trump has a good chance of being elected President of the United States, and markets start to implode. In fact, at one point, S&P 500 futures were down over 800 points. And as somebody that was watching this, I was anticipating a very rough Wednesday morning. But I was surprised because come Wednesday, the market leaps up. Overnight, on November 9th, by November 9th, so a couple of days after the election, the market is up 775 points. And as you can see from that chart, since Election Day through to November 25th, just after Thanksgiving, the markets are up an additional nearly 5 percentage points. So what's the story here? The markets expected Hillary Clinton to be elected. The markets perform well based on that expectation. All of a sudden, it looks like Donald Trump is going to get elected. There's a significant amount of overnight volatility, but then once he's elected president, all of a sudden the markets shoot up again. What are the reasons for this? Well, there are a variety of reasons for it, but I think the chief reason is likely simply the removal of uncertainty. Markets don't so much care who is president, they just want to know who it's going to be. And once the election was finalized, it removed a significant amount of uncertainty. But I want this to be a lesson to those of you that invest, if ahead of the election you were anticipating moving out or into the market based on who you thought was going to be president, I suspect that the end result was probably not what you thought it was going to be, and I hope you didn't do anything too radical. All right, so that's my preaching sermon for today on the stock markets. Up next, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. We're going to be talking year-end tax planning. Stay with us. Welcome back to the Money Pros. I have with me our tax pro, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. It's that time of year again.
Jesus.
How does it come around that fast?
I thought I was here last week.
We could just air our segment from last year, right? It just seems like it was just a little while ago. So we just passed, it seems like the deadlines are spread out throughout the year. Maybe that makes your life a little bit easier. I don't know. Maybe it just ruins more pieces of your year.
It's constant pain, really, is what it is.
But we just passed the extension deadline, so it's the last chance that filers had to file their 2015 tax returns on time was October. And so now the cycle starts all over again. So we are heading toward the end of the year. There is a lot that can only be done in the tax year. I mean, there's a few minor things that you can do sort of before your filing deadline, April 15th or whatever. But for the most part, anything you do to affect 2016 has to be done in 2016. What should people start thinking about right now with about a month to go before the end of the year?
Yeah, so it's right. This is like a big game from January to December. When the buzzer sounds on December 31, the game's over and you got to start fresh. So from October 15th on, we spend a lot of time identifying, reaching out to clients that we know either will have or may have a problem to get them to think about this. Now, most of the time we've already planned for some degree of liability, but a lot of things happen. This was an interesting year, to say the least. So we reach out and say, what happened? Did anything happen we should know about that would create a difference between what we thought your tax liability might be versus what it is going to be? And this applies to employees as well. I mean, business owners have a bigger responsibility to a degree because there's a lot more moving parts typically, but even an employee is going to have bonuses, raises, things that might happen in their life that might change their tax situation.
Yeah,
so it's
what
really
are some of the typical things that you run across where you reached out to that client and they said, oh, by the way, did I mention it? And you're like, whoa, that's important. What are some of those things?
It just happened this morning. Someone was telling me about a deal they're proposing, and the structure that's been devised is not a tax-friendly structure because the attorney was coordinating it from a legal perspective, not including tax. So it happens all the time. So we ask a lot of questions. The more basic ones are, people get married. That's the one that I see most often that could derail expectations relative to refund or balances due. So marriage is a big potential game changer as it relates to tax liability.
Anything with your family dynamic, right?
Right. Divorce is just as equally potentially problematic. Having more children, all those types of things, and all those permeations. So buying a home, kids off to college. There's a lot of tax-related issues that come about right out of the family structure, which are important to consider because cash flow is a big issue. No one wants to get blindsided with a really large tax due, and it does happen.
So maybe to put some people's minds to rest, if your situation really hasn't changed when you think through your family, business if you have one, whatever, and it's really pretty much business as usual from 2015, can you take a step back and say, well, it's probably fewer things I have to worry about, at least in that case?
Well, I think, yes. The short answer is yes, but it always makes sense to look.
Right.
Because you'd be surprised how many times we find a situation where people thought they increased their 401k contribution in January, but they didn't. They did it in June. And as a result, their contribution is not what they thought it was going to be. So I think it takes, for simpler, more or less complex returns, it doesn't take long. You can look at your pay stubs, look at your return, call your CPA.
So that's the next question. How do you get started on this process?
So the first thing, if you just filed in October and found out what happened, right? Then it's a sure you have a pretty good, you know what's happened, and you know you have to fix it. But sometimes people will file on time. They have to go back, look at their return, and see how things worked out for them. Do they have a good result, unexpected or otherwise? Sometimes owing money's not the worst thing. Usually, maybe something really good happened income-wise. So that's the first thing, is to get your information, look at your prior return, look at if you're an employee, look at your pay stubs. If you're a business owner, look at your interim financial statements. A lot of times, business owners don't focus on that. And for smaller business owners, it's more difficult because they're busy working and doing things. They don't really circle back and look at their financial statements and say, wow, I'm having a good year, or I'm not. Right, so that's where the CPA comes in. So when you start to pull that together, the best thing is call, because your CPA is going to know.
And you know, I have to give you a little plug here too, because this is one thing that I find that individuals that do their own tax returns really struggle with. Even though they might be somebody that knows their way around a tax return, it's very difficult to figure out what the impact of some of these changes is going to be, particularly if it's multiple changes, unless you can do you know, estimates of the tax return. And most taxpayers really don't have that ability. You're not going to take a pencil and go through a dozen different 1040s to see how it works out, right?
Probably not, right?
But you can do that fairly quickly.
Almost instantly. So the way our system, you know, I mean, not just me, I mean, a lot of CPAs too, their system's designed to use what was and what can be. So it's like an integrated process. I mean, I can talk through tax projections on the phone with somebody. Hey, look, I just sold a stock and I made $50,000.
Here's what it's going to be.
Here's what's going to happen. Like, so it's that simple, and it makes sense to do that because the tendency is people make money, they don't think about the tax implications, and then they spend the money. And then they had all this money that they could have put aside for taxes that they didn't.
Right, and I think that's the point. Like, as a financial advisor, I can tell a client, you know, hey, you sell this position, you're going to realize $50,000 in capital gain. The rate is 15%. That doesn't mean the tax bill is going to be 15% on $50,000, because it could push a whole series of other things out of whack that could make it a lot more expensive. And that's why, you know, I'm always encouraging clients to go talk to their accountant. Take that number, go talk to the accountant, and find out what it's going to be.
Absolutely.
So they go through this process. Nothing's going to change much from 2015. No harm, no foul. You can, you know, go get another cup of coffee at this point, right? But for those people where something is going to change, you know, they're going to their liability is going to be different than what they expected. What do they do?
So the idea, our objective is to make sure someone's not blindsided, like I said earlier. So if someone had a situation, and we go, like, we've been doing this for, like, I can't tell you how many we've done since October 15th. And we say, look, here's what you're going to owe, and here's why you're going to owe it, and here's some of the things you might be able to do to minimize that. Almost very rarely there's a situation where it turns to zero, but once in a while there might be a key business decision, like an acquisition of a piece of equipment or something with the rules that we have today, that might turn that whole situation around if they knew. So if they don't know, as you said, if you wait till January to find out and you buy that new piece of equipment, well, it doesn't help you in 2016.
So let's assume we're talking about a viewer that is going to owe more than they expect. What are some of the possible things that can be done to mitigate the blow, so to speak?
From a very simplest level would be if they haven't already maxed out their 401k contribution, maybe they do that so that they get as much pre-tax benefit as possible. As you move up the ladder to more complex returns, it's about income recognition and expense acceleration. Maybe there's things they could be paying for that relate to 16 that they were thinking of paying for in 17. Maybe they're better off depending on the method of accounting to pay in this year. Asset acquisition is like the biggest one. People will decide at the end of the year. You see all the commercials on TV, you know, buy now, end of the year, tax savings thing. There's a lot of equipment that's sold between October and December 31st. And if they're going to do it anyway, and that's the problem. People always will call me and say, I'm going to buy, I owe $100,000. I'm going to buy a $100,000 excavator, so I won't owe any money. So it doesn't work like that. It's not a dollar for dollar reduction of liability. It's a percentage of what you spend will reduce your liability. So if you're in a 30% tax bracket and you spend 100 grand, you save 30. So instead of owing 100, you owe 70. So that may rethink it, and I don't like to see people buy a piece of equipment if it's going to sit, you know, in the yard. I ask them.
This isn't a license to go out and buy a brand new 7,000-pound pickup truck, and just because you think the tax bill is going to pay for it.
You're going to make sure it's going to, if you're in business, is that asset, that investment going to make money? Because it's cheaper to pay the tax and have the money than have a piece of equipment that's not making money.
But as you point out, if they were going to get it, now maybe the time to get it. And we've talked in the past about things like tax loss swaps on investments. You know, I don't think that's going to be a great year for that. We've seen most investments go up, most asset classes, so we don't see a lot of embedded losses for clients unless it's some odd position that they've been holding for a while. But that's another thing you can do potentially, is look to see if you have losses that you can realize to offset gains elsewhere.
Especially if you had capital gains, right? So, and we ask, and you're right, most people say, no, I don't, most of those losses have been absorbed and realized already, you know, so we're not seeing a lot of that.
What about people that are going to get back more than what they expected? Great news, move on, or
well, it is great news. It certainly takes a pressure off. They could spend more money at Christmas, I guess. But in the people that pay estimated taxes, they don't really want to make that January payment if they don't have to. So part of our objective is say, look, if you're going to be overpaid, in fact, the gentleman I'm meeting with this afternoon, he's overpaid, and he was worried about having to make a fourth quarter payment, but it doesn't look like he's going to have to do that. So he's going to be relieved to know that whatever he was going to pay in January, he doesn't have to pay, and he'll still be okay. And now we can focus on 17 2017 and see what's going to happen next year. So you definitely don't want to just say, oh, I'm going to get a refund. Most people, we had some clients that just don't want to get a big refund because, you know, it's interest-free.
It's a free loan to the government,
and
right?
they have other uses for their money, I'm sure, in the course of the year.
Sure.
So it's good to know either way. So even if you feel you're safe, maybe you scale back your withholdings, don't make that last estimated payment, maybe accelerate income if you're having an off year and you're in a lower tax bracket than you normally might be.
Right.
Be a good time to drag some income in if it can be done, or defer expenses.
So not to cut you short, but I can't let you leave without giving us your take on the election of President Trump, President-elect Trump, and what that could potentially mean for people's taxes going down the road. We've heard some of his proposals, a lot of it hasn't been fleshed out. What are your thoughts?
Well, I've read several well-done summaries on his proposals, and you know they would be great for the for taxpayers. You know, obviously the wealthier seem to do a little bit better than the middle class, but great tax reduction. I'm all for it. Problem is, it's going to, you know, there's a whole issue about how it's going to impact the deficit. That aside, having a lot of conversations with people about what do I do about the fact that corporate tax rates, we don't have that many C Corps left, are going to be 15%. Now, we've converted almost everyone to S Corps over the years, so now that's going to be an interesting consideration now, a much lower rate at the corporate level than you have at the personal level. So that's going to be a consideration. But on the personal side, the rate compression is good. In fact, if he did nothing else, what would make me the happiest is proposed elimination of the alternative minimum tax. I hate that. It's like it hurts the upper to middle class families the most because the biggest deductions they have are real estate tax, income tax, state level, local level, and they don't get it.
So we're just going to have to wait and see, though, because these are proposals, right? It doesn't matter until Congress passes something, the IRS puts it into action. It's just a waiting game.
It's just a waiting game.
Greg, thanks as always. Great information.
My pleasure.
All right, up next, we're going to be talking about missing retirement funds. Do you have any, and how could you track them down if you did? Stay tuned. There's more to come on the Money Pros. Welcome back to the Money Pros. So let me ask you a question. Do you know where all of your retirement funds are? Now, keep in mind that most people's retirement funds, or the bulk of retirement funds, are through workplace-sponsored retirement plans. Now, back in the day, when somebody worked at the same employer from cradle to grave for 30, 40 years, you knew where your pension was, you knew where your 401k was. There really wasn't a lot of mystery to it. But now there's a lot more jumping around of jobs. The days of one job for a lifetime are over for most people. So with the increased turnover and the typical individual potentially having 3, 4, 5, 6 different employers throughout or more throughout their working lifetime, a lot of evidence is suggesting that people are forgetting where all of their retirement benefits are and what they are. So a couple of interesting statistics. One of them is from some research done by Aon Hewitt. We've talked about these folks before. They're a large pension consulting firm, work with some of the largest pension plans in the United States. They estimate that 30% of pension accounts may actually be lost or unclaimed by the participants, and they cite two different reasons for that. One is that the plan, the employer that sponsors the plan, can't locate a former employee. Employee leaves, they lose track of them, address has changed, they don't know where they are anymore. And secondarily, they also indicate that in some cases, employees either forget about retirement benefits they may have been eligible for at past employers, or they can't actually find the employer any longer. They don't remember who it is, or in many cases the employer went out of business, but the plan is still in existence. So this is increasingly common. Here's another statistic. U.S. Department of Labor's Philadelphia office indicated that 50 large pension plans, 70,000 participants older than 65 are not collecting on over $100 million in annual benefits. And they contacted over 5,000 of those participants that indicated a large percentage of the 5,000 they actually got in touch with were unaware that they were actually even eligible for any benefits. So what do you need to do if you want to try to track down retirement benefits that you may be eligible for? Well, let's go through the list. And the first one's already up there. Write and or email former employers. Now, you don't have to wait until the day you retire to do this. In fact, better to do this now, regardless of where you are in your work cycle, than to do it later. Get in touch with former employers and make sure you understand exactly what retirement benefits you're eligible for. Typically, you're going to go to the Human Resources Office or the Benefits Department, and they'll be able to provide you with contact phone numbers, information for the plan, what balances you may be eligible for, and also update your contact information so that they can reach you at particular moments, particularly when you turn 59 and a half, and in most cases are required to take distributions from your plan. Next, check government databases. There are actually government databases available through the Department of Labor, Pension Benefit Guarantee Association, and a variety of other organizations that track pension plans, and you can check those databases to get contact information for employers. And Congress is actually working on a centralized database so that you can actually look up lost accounts potentially. So stay tuned on that. And finally, you can actually check with state unclaimed property records. We have those here in Rhode Island, Massachusetts, generally maintained by the treasurer for the state. And if there are unclaimed accounts, this would be particularly useful for things like IRAs and brokerage accounts. You may have benefits out there that you're not eligible for. So this is a problem, and it's a problem that's likely to become more and more common, particularly with automatic enrollment in 401k plans becoming more prevalent. So be aware of what you have, and if you're not aware, make some effort to track it down. Money's too hard to come by to just leave it setting without paying attention to it. All right, up next, a question on adjustable rate mortgages. Stay with us, there's more to come right here on the Money Pros. Welcome back. Got a question from a viewer that I think is probably being generated based on the fact that we've seen interest rates come up, particularly on mortgages, since the election of Donald Trump. Viewer writes, I have an adjustable rate mortgage on my current house. It seems like mortgage rates have gone up a bit, and I'm wondering if now is a good time to refinance or is it too late? And the way I would answer this question is to say, or to give the same advice that our mortgage pro, Steve Tetzner, has given us on several different occasions, and that is adjustable rate mortgages are fine if you don't plan on being in the property for very long. In all likelihood, if you refinance your mortgage now, particularly with the rise in rates, you are going to end up paying more than where your adjustable rate is right this second. So you really have to consider how long you're going to be in the property. If you're going to be in the property for a little while, maybe your plans have changed from when you first got the adjustable rate mortgage, you may want to consider locking in rates. In all likelihood, rates are as low as they're ever going to be. Whether they stay here or go higher, and what the timing of that is anybody's guess. But you really have to consider how long you're going to plan on being in the property. Hey, thanks for watching the Money Pros. We always appreciate you joining us. Please be sure to join us again next Sunday right here on the Money Pros. Have a great day, folks.